You're starting a new investing business at the golden age of 74. Why?
Look, I think from my point of view, the gift of being able to move freely around the world, have a job that has a beginning, a middle, and an end that's contributive in some form to the freedom that we have adapted in America and my ancient civilization of Lebanese DNA as a gift. So I love it. I feel that I've paid the price to be able to know what doors to knock on and what doors to open. In a little more relaxed atmosphere at Colony, we
had some work to do there.
We did. We found a great new CEO in Mark Gansey. We flipped the company on its side. Great teams, great focus, amazing directors, but difficult in a pivot. So I'm ready to breathe a little bit and just do only those things that only I can do, which are very few.
You know why I asked the question, though. You've had a tremendous career. Nobody would dispute that. You're pretty rich. You could retire if you wanted to. Why go back to doing what you were doing 30 years ago?
Because what I did 30 years ago, I had no idea what I was doing. And the thrill of learning.
I think Bob Bass taught you a few things.
Well, Bob Bass and David Bonneman, I owe everything to them. I mean, that decade was amazing. And what they bred in normal people like me and some of my peers was incredible. But it's that, right? It's pushing through those comfort barriers. It's taking on complicated issues and things that just keep you supple, that keep you fresh, that keep you in the game. I have friends who have retired, and as soon as you step off the gas, bad things happen.
It's the fear of mortality in some respects that's driving you forward.
Yes, the reality of mortality. You have to run faster. What I'm interested in doing is just investing myself with my family office and club investors in elephant transactions that have tremendous opportunity and residual in this dislocation, not to build up an asset management. What I've learned over time is to turn right when everybody else is turning left. So we're in the midst of zero interest rates, a proliferation of money supply that we've never seen before, Fed buying assets at a rate that's unparalleled, all the things that you cover all the time. And everybody's yield driven. So much liquidity, the world is in a thirst for yield. So for me, it's time to not look at yield and look at total return. To look at total return in this technological revolution where everything is disintermediated, you start at home in kind of acres of diamonds. So instead of creating a theme, all of the big asset managers create themes because the institutional investors want to check a box. So if you're growth, if you're venture, if you're real estate, if you're private equity, you stay within that theme, and they hate theme drift. I only like theme drift. If you
so when people say you're inconsistent, your response is, yeah.
Yeah, exactly, which didn't work well in a public company for me, right? I mean, as a CEO of a public company, I'm not great. I came back to fix the company, which I was capable of doing because we found a great CEO and a great team and a great set of directors. But the consistency of saying, I'm going to draft a theme, I'm going to take a year with the smartest men and women in the world to draft a theme. Then I'm going to go out in the world and I'm going to prove that this theme is correct. You just evade all the opportunities that are coming your way when you're in the middle of that world. So I've looked at it and said, my competitive advantage, everybody in my business is much smarter than me. So I had to look and say, okay, what's my competitive advantage? Number one, show up. Number two, do what I say. And number three, farm the relationships when I don't need anything. So that fabric of just farming relationships and looking for those outsized transactions that just have an edge, where you have an instinct. Everybody has the same knowledge. Everybody has the same cost of capital. It's impossible to have extraordinary returns in a marketplace that's flat. So
you say you want to turn right when everybody's turning left, or turn left when everybody's turning right. What does that look like? I know, everybody knows what left looks like today. What does right look like? Give me some examples.
The hospitality industry, as it relates to wellness, as it relates to health, as it relates to the next model of what's available, as it relates to fractional ownership of that residential brand, I think for the top brands is going to be on fire for the next 36 months. And there's very little capital. The risk reward for capital, that's the riskiest. So capital is very hesitant to run into these developments of mega resorts, even with branded residential. So it's one area in which I look and say there's a tremendous competitive advantage priced with the right stewards of wandering through that jungle, because people are going to start traveling, COVID or no COVID. It's a different kind of a product. They don't want vertically built buildings like they are in Miami. They want something else. And what's the counter experience that you can have from virtual reality on all these iPhones? Is experience something.
When you started in this industry, back in the 80s, real estate was a cottage effort of sorts, right? Today it's dominated by giant platforms. And I wonder, others will wonder the same thing. How do you, Tom Barrack, with some deep-pocketed LPs and a relatively spare staff, compete with the hundreds of billions of dollars in funds and permanent capital, not to mention the thousands of employees at Blackstone, at Brookfield, at Starwood? How?
You don't compete with them, right? I mean, they're
not chasing the same things you're chasing?
No. They're first-class organizations with unbelievable teams, great people, a very low cost of capital, a gigantic international network, and they're in the alternative asset management business. So scale and AUM is the name of the game. So the cracks, when I look and say, okay, so what can we do that's feasible, that's interesting, that moves the needle,
and that they're not doing.
That they're not doing. It starts with just a little edge in the complexity. I mean, think you have $88 trillion of investable assets, right? I mean, that's about what it is around the world, 88 trillion. Half of that is real estate, half of it. And most of the real estate is not owned by them. It's owned by little moms and pops and teams and hooies of people who have had some angle on whatever it is. By the way, I'm not so interested in real estate is slow moving in this environment. And it's low yielding in this environment. So I'm not really focused on that. I'm focused on the disintermediation, what's happening to everything in real estate as it rolls to digital real estate. And that the vagaries of what that is huge, because CapEx in real estate is the killer. It's the four-letter word. So if you own an office building, you couldn't replace this office building at $2,000 a foot.
So hang on a second. Tom Barrack is sitting here telling me that he's really not a real estate investor anymore.
Yeah. No, it's true. I haven't been a real estate investor for 5 years. Why? Because it's too efficient. Now think about it. Why should you ever have to go to a bank to get a mortgage? Why do you need a title company? Why do you need a real estate broker? We're turning from products to services on everything, right? And by 2030, probably people won't own anything. They'll partially use everything. And what I've discovered as being a financier of real estate is you pick an athlete, which is the key. We're still doing that. So you find a great individual like Mark Gansey, who does digital, or a great individual like Jim Herbert, who does First Republic, or Richard Nanula, who took us to Disney and Miramax. Bet on the athlete, don't worry about the sport, or you bet on the stadium. So as assets build up under management and scale, they're doing it for diversity. I'm not interested in diversity. I'm not interested in scale. I'm interested in finding an edge, an instinct, an athlete, some out of favor piece going in a different direction, and it's right under my fingers. I haven't gone outside of my own network for a transaction in 10 years. We don't bid on green books, blue books.
Give me an example. I know what you're talking about as it concerns Digital Bridge, because I've seen those deals. What's an example of the kind of thing you'll be doing at Barrack Family Office, Falcon Peak, whatever you want to call it?
So what's happening to GP players, smaller GP players, for instance, is the GPs are running out of their own capital. So if you think of what the transaction used to be, a GP like us, or a great GP with 5% of their own capital in, and the investment period would be a couple of years and the harvesting period would be 5. Now the GP's putting less capital in, maybe 2.5%, but the investment period is 4 years and the harvesting period is 10. They're running out of GP capital at a time where they want to start taking risk off the table. So just looking at the credit stack and saying, we can go in and take part of that GP capital because I'd rather invest on the athlete. So if I know who the LPs are and I know the GP, when you say, why do we not have any staff? I've got a brilliant, long-based team of 4 people. But if I know who the GP is and I know who the LP is and they give me an opportunity to invest in that stack behind them with relatively no due diligence, because I've been in the business for 30 years, I know who the surgeons are. That's a great opportunity.
Beginning to become much clearer to me. How many of these deals, Tom, do you anticipate doing in the space of a given year?
2 or 3.
Really, that's it?
Yeah.
But we're talking about tickets of what size?
I think equity tickets, so I formed a little club of the institutional investors around the world that have been with me since the beginning, really for the gift of Bob Bass and David Bonneman. It's where we started. There was no leverage buyout business, there was no alternative asset business. And I think, writing equity tickets of $300, $400, $500 million is about where we'll be. So you need an arsenal of a couple $1 billion in each category of equity. So if you just look at the power of that, going to residual and no yield, right? In other words, without the necessity of saying, I want a current return on that capital, which is unusual in this marketplace, everybody's dying for it, and real returns are negative. So it's hard to understand, is we don't have to do much.
So you're in the capital appreciation game.
Absolutely.
Everyone knows that you have deep and long-standing ties to the Qataris, to the Emiratis. You have a history in Saudi Arabia that goes back to one of your first jobs ever in the 1970s. Are they all behind you in this effort?
Yes, yes, and various mechanisms. As we've talked about before, the region is so complicated.
I heard that the Ambani family is also backing you. Is that true?
Yeah, they are. Mukesh Ambani is one of the smartest human beings I've ever met. He comes from amazingly humble origins in one of the most complicated countries in the world. And he's a tremendous role model. When we talk about long line relationships, he's thinking a decade ahead. I have a hard time thinking 10 minutes ahead. And he has an incredible team, and India is an amazing place. If you look at India and China, and you just look at the numbers of where's the world going, and he's a great friend and a valued partner.
If yield is a proxy for risk, or cap rates are a proxy for risk, then there is no risk, right? Nothing's extraordinary. Everything's low. Everything looks riskless by that measure. So in 2021, what does extraordinary risk look like?
Well, I mean, cash is trash, right? This is the problem. You have proliferation of liquidity, and you have amateurs in the marketplace. So you look at what's happened to the retail stock market. It's incredible. I mean, I love it. I don't understand it. I watch it, but it's an entirely new phenomenon. So every individual is sitting saying, you know what, I make more in my 401k or day trading than I do making a living. So kids going to school are sitting here saying, why borrow money to go to a university for 4 years to come out and try and find a job when you're crushing it in day trading or just buying the S&P and you're up 16% on an annual basis? It makes zero sense, right? It can't sustain itself for long or forever. So in looking at saying that's where everything is going, and in our businesses, looking at multiples of revenues, not multiples of EBITDA, not multiples of income, multiples of revenues. How can it make any sense? At some point in time, you need cash flow to feed people. So going to the opposite end of that, the risk curve again, where people are saying, I'm not getting any yield, I'm not getting any current return, and I'm betting on some macro intervening event or some macro continuing event to produce residual pop somewhere down the line, is a smaller universe of people who are willing to do that. I'd rather be with a smaller universe of people who are professionals in the jungle rather than the amateurs who are looking for current return and you're just waiting to be discovered in the jungle.
Tell me, what do you see as the most powerful and most enduring trends to emerge from the pandemic?
Look, for sure, I think the things that we've all been talking about, the work at home phenomenon, the ability to conduct all of your affairs efficiently without the structure of an office, works on everything except culture, right? So what can't you do is it's hard to build a culture remotely. But if you just look at Zoom, if you just look at the colony, at the digital bridge business, the volume of technology over the COVID era for everything, for wellness, for sports. I mean, look at DraftKings. I was watching the Tour de France. You can bet on every stage in live time up to the last 100 meters. The technology and the algorithms are unbelievable. Everything will continue to be disintermediated, and our lives will change that way. So these kind of beautiful office buildings that took 20 years to bring into effect will continue to exist. My feeling is it gets repriced.
You know, my ears prick up when you say repricing. Commercial space in New York City reprices by how much? What does it take? What is low enough to drive the repurposing, the readaptation of these skyscrapers?
Well, I think, for instance, New York City will always come back. I have no doubt that New York City will always be a viable marketplace. But it's the intersection of a number of things: a viable political environment, a tax regime. If you think about what we're going into, one of the biggest threats in these big cities is real estate taxes when we talk about commercial real estate. Why? Because we're printing money, we're going into debt everywhere. The states have no money. So what's the low-hanging fruit to collect revenue? Real estate taxes. And from whom is it the easiest to collect? Is the big owners of the big buildings. So in order to reprice, you have a political balance that needs to be stable. You have a tax regime that's got to be understandable. You have a quality of life that's got to be police, fire, the delivery of services, and a residential fabric that makes sense for people to live in, that's safe, reliable, and affordable.
I'm curious to know, what cities do you think are most vulnerable to these forces? And which ones would you bet on?
Los Angeles, San Francisco, for sure, right now, are the most vulnerable. The political situation is horrendous. Businesses are moving out of California at the snap of a finger. It's a hostile environment to try and hire help, employees. The cost of living is insane in all those places, and it's a counter on the human resource side. It's a countercultures, and Los Angeles never was a high-rise city to start with. You know, built on really media and Hollywood, and now media and Hollywood is where? I mean, Hollywood is everywhere. They don't make movies in Hollywood anymore. It's the most expensive spot in the world to make a movie. And now we're over the top. You don't need to be there. Movie theaters or something, right? Everything shifts. San Francisco, the same thing.
You're swearing off real estate, in a manner of speaking. What do you think of the people who are still raising billions and billions of dollars for real estate? Obviously, there's still a need for real estate. People still need to live in a house or in an apartment building, and companies are going to want to occupy some space, even if it isn't, you know, the 50th floor of some midtown tower here in New York City. Yields are awfully low. What do you think of that asset class?
I'm off of real estate in scaling to be a major dominant force, as Colony was at one time. But within that credit stack, there's lots of places to play that are broken, including with European banks, right? the regulatory environment on many of these things forces people to make decisions that are illogical.
Your pitch to your new investors, many of whom were your old investors, is a highly personal one. And I want to summarize it. In fact, I want you to summarize it, but I'll start. Invest with me, Tom Barrack, because. What comes after because?
Well, what comes after because is because I'm putting my own money in ahead of yours. I have 40 years, amazing, I can hardly even say it, that I have 40 years of experience in these jungles to understand where we're going and relationships to make it work. And I'm only interested in doing high quality, extraordinary, rare and scarce transactions which have a gigantic total return perspective. So I'm not in the asset management business. I'm not in the other silos that are good silos that they need to invest in. And I'm not giving them a pitch on a fund.
The reason that Blackstone allows CalPERS to co-invest or CPPIB to co-invest is because they are charging them 2 and 20 or whatever on the commingled funds that they're in. How do you make money? What's your VIG?
There's no VIG. We make money when we make money. No, look, John Gray, I love him. He started as a pup with us. There's nobody better in the business. But Blackstone, at scale, Blackstone can do things that nobody can do. Right now he's gone above the waterline. So to compete with them there, or to have the flexibility to do what they did in Hilton, is complicated. But that model, public company, fee income, which gets a multiple. By the way, the promote gets no multiple. So if you look at any of the alternative asset, I mean, this is why I only want to go to the promote, is everybody's focused on.
That's how you make the money, on the promote.
On the promote. Because.
There's no management fee.
No. Because I'm not managing a fund. What I'm saying is, I want you to come along with me because it's scale.
Scale creates the opportunity.
Scale creates the opportunity, and I missed, my dad was one of the greatest grocers in the world, but I missed my industrial trust fund someplace, so I need additional capital along the way. And all of the super smart guys, the John Grays, are in the business of mostly creating fees that have a multiple in the marketplace, and they do a brilliant job of it, but the promote in the public market gets zero. It makes zero sense to me. So I want to go to where everybody's not private.
We do have to talk a bit about your legacy at Colony, an incredibly successful firm for so many years, but many of the shareholders who are in Digital Bridge now remember only the past 5 years. And they went from 24 to 4, they're back up to 8. They're happy about being at 8, but they're not happy about being down from 24.
By the way, 24 was North Star, not Colony.
Fair. But they ended up in the same security. To the degree that things went wrong, that you misjudged, what was it, if you look back on it?
A series of things. I mean, I think number one, it rests on me. In 2016, you remember I went to play with President Trump. I thought that was a great opportunity for me to pay back. He was a friend, he is a friend. It wasn't political. I never looked at it that way. I'm not weighted in Republican or Democratic cycles. And had appointed a CEO, very capable, competent CEO. And at that time it was merger mania. And they decided at the time that the combination of those, of Colony and North Star, would take it to 140 billion of assets, and everybody seemed like it was a good idea. And I probably had my eye off the ball because I was concentrating on, at that time, the campaign and the transition and then the election. And it was a bad deal. It was a horrible deal. So in 2018, the board asked me to come back and fix the problem. And it was a nightmare. very, very complicated. I take responsibility for taking my eye off the ball. It's too hard in these big companies to do all of those things well. And it's all about people. It's just all about people. So having a light rein on people who are better than you is the key, which is why I stepped out. It's hard to do. One of the other lessons is founders regret. I see it in all my friends. Nobody can step down. Everybody says, public companies say, what's your succession plan? And the underlying joke is, every CEO says, are you kidding? You killed yourself to get me here, and now the next thing you want to know is, who's going to follow me? And you're going to follow me in the hearse, right? Is how they really feel.
5 years ago, Tom, the only people who knew the Tom Barrack name were institutional investors, bankers, creditors in capital markets, your fellow surfers at the point of Malibu. Now everybody knows your name because of Donald Trump. You supported his run for the presidency when almost nobody on Wall Street did. You chaired his inaugural committee. Looking back, I'd like to know, how do you feel about the role that you played in his political ascendancy and his presidency?
Look, the answer is anguish, agony, all of those things that go through the disruption, right? When you look and say full circle, when you look back at that process, it wasn't fun, it wasn't rewarding, it wasn't any of those things. And I knew the game going in, right? So I knew all those things eventually happens when you enter that political arena, especially from a business point of view. There are very few businessmen that ever survive in the political milieu in Washington, ever. It's a different, including Donald Trump, by the way, who I have great admiration for. And I did this, honestly, at the beginning, thinking that he was just renegotiating his apprentice contract, right? At the very beginning, nobody really knew was he serious or not serious, but
including you,
including me. But he was a friend, and he needed some Wall Street institutional help. So Mnuchin and I were kind of the only guys available at the time.
But you were public. Mnuchin was quiet about it.
Exactly. And Donald is, as we've seen, he's a tour de force. His instincts are amazing, and he found a fissure in America that he drove a truck through, and that was an amazing adventure. Watching it was an amazing, and my admiration for him, and having the thick enough skin to really drive through all that and adapt and adapt and adapt.
Any regrets?
No. Look, I look at from my simple beginnings of where I came to have the gift and the opportunity to be next to a president of the United States, to have the honor of running an inauguration, to be up close and personal on some issues that affect world order. I paid a personal price for it, right? The adversarialness of America in squaring off on both sides is something I still don't understand. But I'm honored, and I look at I support the President of the United States. Joe Biden, number one, I know he's a superhuman being. And on the other side of this, I hate what's going on now, is the adversarialness of, great, we've been through this. Give this guy a chance. Why don't we all as Americans just say, great, maybe we like it, we don't like whatever it is, we're going to stand behind him and give him a chance. Something's happening in America. The divide between the haves and the have-nots is too wide. It's too adversarial.
You were about as close to being in the White House without actually being in the White House. How do you think history will judge the Trump presidency?
I think better than it looks right now, actually. I think a large amount of what he did substantively was solid. What didn't work over time, which I've found for all of us as a lesson, is we're not ready to pay the price of harshness or abusiveness or of bad rhetoric or of bad global elegance and conduct for what appears a short-term gain. So when people criticize that period, it was mostly attitudinal. right? Had he switched, which he was capable of doing, had he switched his attitude, become more elegant, more patient, less abusive, why did he not do that? I mean, my humble opinion, as we talk about it, is there's a constituency in America that didn't want him to do that. There's still a constituency that does want it, right? When you talk about people who don't want to be vaccinated, it's red and blue. So I think historically, a lot of the things that he did will be well appreciated, but you know, this job of being the most powerful human being on earth is very difficult.
How does history get over the claims of a stolen election and widespread fraud? How does history get over January the 6th?
Probably doesn't. It doesn't, right?
So how does history judge the Trump presidency favorably with that as its bookend?
Well, because history is in segments, right? So that portion, however we look at fraud in the election, there's fraud in every election. The manner in which this was approached and the drama of which he portrayed it was not elegant. Whatever the reality of it was, is...
Well, some people would use considerably harsher words to describe it.
Yes. So I think that part is always going to be, there's people who are going to continue on this conspiracy theory, regardless of what. That's their category. It's a political issue for the Republicans to use in coming back, which is just warfare, which I think is not worthwhile. I don't think it serves them well either, by the way. But the pieces along the way of things that got done during that period and things that were fixed during that period, including the things we've talked about, ISIS and terrorism and all the things we were. So
resetting the relationship with China.
Yeah, absolutely. And you know, the relationship with China is another thing, or the relationship with Russia. These are difficult things in retrospect to analyze. I think what people didn't like is the way he conducted himself. The things at the end, I mean, it's unthinkable, right?
Can you get over those things? Can you get over the election?
No, he'll always be my friend, but I think it's ridiculous.
Let me put it to you this way, because I think this probably, you know, and my interest here is not an inquisition about Donald Trump. It's, you know, the man, and obviously he's left quite a legacy for the nation to wrestle with. Knowing those things, knowing the good and the bad, the things that you do think are positives and on which he'll be judged well, and the things that are negatives and for which he'll be forever criticized. Would you support him if he ran again for president in 2024?
Look, I'm out of the support business. You know, I root for America.
Well,
so what I don't like is divisiveness. I think the world of him, I do. And I think he was well-meaning. The confusing thing is he's not evil, he's not demonic, he's not any of those things. He was driving to a constituency that he really believed in. That being said, we have to get over this adversarialness. Most of us are fiscally conservative and socially liberal. And this idea of these ancient Democrats and Republicans vying against each other in the toxic
I don't
wasteland.
disagree with you, but if he were to run in 2024, do you think he'd be running on a campaign of divisiveness or a campaign of unification?
Well, today it looks like it's a campaign of divisiveness, which I'm not interested in.
I tease you about being 74, but the reality is, as anyone can see, you're as youthful and energetic as I've ever seen. How long do you see this new venture playing out?
I hope I can do it as long as I'm viable, but I'll tell you, the thing that I've learned is you have to know when to fold. It was, you know, with Colony, it was a great lesson for me, and I sit on a couple of boards where I'm watching that play out. It's very difficult to go to the next play. It's very difficult to step off of that power base, especially when you've been invested in building it, and that's also the worst thing that can happen. So you're going to see it happen in the alternative asset management. We all started together, right? They're better, smarter, wealthier than I am, but they're all at the point in their life where they're trying to say, so what is the meaning? They'll have more money than they thought they were going to have. They've done better things than they ever imagined. They've built great teams all over the world. They have global connections. Their families are grown. I love this. I would pay. I'm not saying that to my investors, but I would pay to continue to do it. It's a gift.
Tom, it's such a pleasure.
Thanks. Love
Thank
being
you.
with you. Thank you.
Thank you.